I think some of our panelists are up early, and we appreciate that. Their minds are awake because I know they've had at least three shots of something. So what's happening? Brent crude oil this morning trading a little bit higher as it sort of created some momentum yesterday with Brent crude oil moving up above 81.61. At the moment, it's little change, seems to be bouncing up a few pennies and down a few pennies, but ultimately wind in the sails, it would appear, after some great uncertainty last week. Let's kick off this morning and going to Paul Hicken, editor-in-chief at Petroleum Economist. Paul, what's your read at this stage? Obviously, the big news of the week in terms of the immediacy of the oil markets has been what's happening at OPEC Plus. So my question to you is, what's happening at OPEC Plus, and what do you think is the decisions that will be made this week by the group?
Yeah, so obviously the real question is it's probably three ways we can look at it. First of all, there's a dispute over baselines, which has been well documented over Africa. I think that issue is complicated more. I mean, if you talk about Africa baselines, then it's probably not that big an issue in some ways. For OPEC Plus as a wider group, yes, it is a big deal for Angola and Nigeria, but I think for a wider group, you've probably got other pain points. You remember Iran is coming back another million barrels a day of supply over the past year. You know, that's the Saudi lollipop that right there. It might not be as widely acknowledged because they're exempt from quotas, but that's a real pain point for Iran. Even Libya, 1.2 million barrels a day. It's been stable for some time now. It's unusually for Libya and all good for them. But at the same time, for OPEC Plus, that's another complication because they had quotas drawn up around the 1.6 million barrels a day, and how realistic is that in the next few years? It's looking like 1.2 is more the stable level, and there are probably things going back in the back channels even around these situations, not just because you think about for the year ahead, and you look in if OPEC Plus you're looking for probably hunkering down for a while into next year. If you look at where the bearish trends in China and the OECD, still we're not out the woods at all, and they're probably thinking, well, if we just get a rollover, and if Saudi's just picking up the tab, how long is that sustainable? Especially if they really want to support that $80 barrel a day oil price floor. And this is still some hard talks going on. I think there will be a deal being done, but if it's just a rollover and a little bit of a fudge, we could be back here in early January again, and nobody really wants that. That's happened before in the past as well, and they've probably learned the lesson from that. So that's why they've delayed the meeting, to really try and get a proper deal, proper agreement where everyone's on board with.
Let's go to Matthew Wright, a senior freight analyst at Kepler, to read the tea leaves. Matthew, in the world of freight and the macroeconomic outlook, quite often can be the cuckoo in the coal mine is on the freight rates. What are we seeing there to tell us about the health of global economic growth and demand in the first quarter?
Yeah, and good morning, everybody. I completely agree with Paul. I think if you go back a couple of months, the narrative was, oh, do you know what? It's looking like a rollover is going to be the status quo, and now we're in a situation where a rollover is not really going to be enough, even, is it? Yeah, I agree. You've got the side issues around Angola and Nigeria. I think there's a little bit of a mismatch in terms of where they've allocated the new revised cuts, but like you said, that's not the main story. The main story is just the overall target. Our view at the moment is definitely going to be a rollover, but not just through to the first quarter, through the whole of 2024. And deeper cuts are definitely on the table. But Saudi's going to be looking to see if everybody else is willing to sort of participate. On the freight side, we're entering a period of traditional seasonal strength. We had a real big jump in some rates last month, but that's sort of cooled off a bit. The main narrative around VLCCs is everybody is looking to the Atlantic for what is going to set the price, not the Mideast Gulf. The Mideast Gulf, it's clearly the main load area from VLCCs, but in terms of spot market activity, everyone is looking to Brazil, the US, and West Africa to a lesser extent. So we're looking at the really some of the main non-OPEC producers from that perspective.
Let's go to Alex Hazel, Senior Analyst at Wellington's Energy Analytics. We've got an all-British lineup this morning, Alex, but I know you guys keep a strong focus on Asia. Is Paul and Matthew a little bit over-egging the pudding there? I mean, we had the US economy print a 4.9% growth in the third quarter, with all the basis points on interest rates peaked now and rates yields coming off. So where is China at? It could hardly have a worse year than it's had this year. And so all things considered, US economy moving, China could be better next year. A rollover's enough, no?
I think generally, I actually tend to agree with Paul and Matt, to be honest.
Well, then you're fired. Bring on the next
Yeah,
person
I know.
who disagrees.
I'm sorry, I'm not bringing a contrast to this conversation as much. I think what we're tending to see out of China is that demand remains quite weak, and you also have a lot of trade tension between the US and China. It's unclear how quickly China is going to recover from its various from the various tensions that are going on. The other challenge is data coming out in terms of things like Russia, for example. We're talking about how different quotas are going to be divided up, and we don't really know for sure how much Russia's exporting because it's not releasing the data to OPEC. So that is a major challenge for OPEC, is how do they adjust quotas when potentially there's a major source of someone breaking that quota system. Is Saudi Arabia willing to, and that's what Russia did back in the 90s, and so is Saudi Arabia willing to go down the same route again for another year, or deepen the cuts even further? I think it's a real challenge. So I think they'll probably kick the can down the road, is our baseline view, and they'll just keep the cuts for the coming year and roll them over.
Paul, I wanted to get your insights on, I mean, it's slightly semantics and insider baseball as the American parlance goes, but that OPEC now is facing a decision. I mean, there's obviously the need to support prices and to quote unquote balance the market, as they would call it, and keep a tight frame between supply and demand. But then there's the sort of underpinning of that ultimately, which is keeping quotas and reality in the same bucket. And we've spent a lot of the last sort of COVID recovery where quotas, officially designated quotas, and capacity to produce at those quotas have been disconnected for many members, particularly the African members and those that are not investing in the rehabilitation of production capacity. How big of a challenge or big of an issue is that, do you think, at this moment, getting those two things into alignment before you can start building a strategy for 24? You've got to get reality into the same bucket. Your thoughts on that?
Yeah, I mean, it's a good point, Sean. And I think when we were back here in 6 months ago with the UAE and with the African baselines, and it was all drawn up. So clearly, when that agreement was struck, people were left there not that happy, and there was a few. Probably why the lollipop came out. It helped everyone suck up, especially some of the African producers, probably suck up that deal. But that can's been kicked down the road, and we're back here again. It's difficult for some of the African producers because their production's been all over the place, given the a lot of the issues they've had, trying to make some sort of recovery, especially in Nigeria and Angola. They've tried, they've started to try and turn it around, but you're never quite sure. I'm not sure how big an issue the buckets are. I mean, I'd like to be more controversial and say, I mean, look at the agreement. Look at how they stick to the quotas. There's normally some wiggle room. You've already got several months to whether how much you can stick to quotas. You normally can sort of agree. You can overproduce for a little while. No one really, Iraq was doing that for ages back a few years ago.
I mean, if you look at the question of the African quotas versus their production capacity, if you just reduce their quota to their production capacity, you already grab a nice headline in terms of deeper cuts, if you know what I mean, although they're ultimately fictional.
Yeah, and that's also the problem. I mean, fiction and reality. I think OPEC Plus is probably, they've been trying to overhaul and reform for many years, and they've been making changes, being more flexible, meeting monthly, all really positive changes. But there's probably still more overhaul to be had. Exports versus production is another big pain point for them as well. What is actually coming out of storage? What's coming out of actual production? The wellhead. There's lots of probably other issues, and this allows this kind of what you said, Sean, fiction versus reality. And I think there's also one other thing we should talk about, which is market structure. It's not just the flat price for OPEC Plus and the Saudis. It's also market structure, making sure keeping stuff out of storage. That's also privately, OPEC Plus delegates are concerned about market structure. I know it seems a bit of a technical thing, but it is important. The market further down the road, and that's also an important consideration. So there are other considerations, even though that sort of $80 barrel floor is very important for them right now.
The question, Matthew, I wanted to bring you in on that we've seen bubble up and getting certainly coverage, and is the resurgence in the sanctions enforcements on Russian exports, and particularly those tankers that and those fringe companies perhaps, but also fairly established actors in Europe as well, that we've seen some tankers now back away from lifting Russian crude. Your thoughts, Matthew, on whether this sort of builds to being anything of scale that could have an impact on Russia getting its oil to market, which it has done very successfully over the 18 months of its invasion of Ukraine?
Yeah, so the Russian price cap is sort of got renewed interest in the last month or so, even though Urals has been trading above the price cap since July. ESPO has been above the price cap since January. There was a bit of a lull in that. I think G7 and the US sort of sat back to take stock of what should we do about this, because I think they were quite fortunate when the price cap came in last year that the crude price was actually very low and stable for a long period of time. The price cap worked by accident. So now, we've got 30 shipping companies have been sent letters basically to say, could you please show us your due diligence around how you've been handling the price cap? And there were 3 ships were sanctioned last week or the week before, and then there was a couple before that. So the 3 ships is nothing, not a big deal. And to be honest, they're all Sovcomflot ships, so they're just sanctioning Russian ships, not an issue. The 30 letters is more of a concern, and I mean more concern in terms of we're going to see more of a market reaction, because they are the ones who are either owned within a European country or use European or US services and insurance. And like you said, we've already seen at least 3 Greek owners step away, having previously been more involved in loading Russian crude and refined products. So what that does is that basically reduces the size of the fleet that is loading from Russia. So the Russian freight premium has gone up. And what that's doing is it's pushing some of those ships out into the sort of the non-Russian fleet, and is going to depress rates there. At the moment, I'm not concerned around any issues in terms of the ability to load from Russia. There's plenty within what we refer to as like the grey fleet and the dark fleet to sort of maintain Russian crude exports. But if there's more efforts sort of pushed ahead around enforcing and or sort of furthering sanctions around Russian exports, then we might start to see some tightness that could cause an issue. But at the moment, it's more that we're going to see a reduction in the number of Greeks involved, and an increase in the grey fleet.
Alex, I wanted to get your thoughts on obviously COP28 is about to kick off here in the UAE tomorrow. The Pope might not be coming, but a lot of other big hitters are in terms of this important event. And I know Wellington's has been doing a lot of coverage recently on carbon capture storage presence in the UK, and a report on Wintershall, etc. I'm just wondering, from your perspective, with all that's COP28 big event, we saw COP26 in particular seemed to have some resonance for the energy industry, given how strong the energy transition came out of Glasgow and then faded as energy security soared to the forefront. I'm wondering, should the oil and gas markets be paying attention to COP28 this year? Is there anything that could come out of it to impact the direction of oil and gas markets over the coming months? Your thoughts on how much the oil and gas markets should be keeping an eye on events in Dubai over the next 2 weeks?
I don't think. I think oil and gas companies have always looked at COP26 to COP27, and everyone's looking for indications about how quickly governments and regulators are going to move towards an energy transition agenda effectively. A lot of, particularly the challenge in terms of developed economies as they were, how quickly they're going to go towards a CCUS function. We've certainly seen that in Europe with a lot of new CCS licenses being awarded, projects being pushed forward. A lot of the below ground issues have now been sorted, and a lot of the challenges have been above ground in terms of sorting out regulations and basically the legal regulation around transport of CO2, for example. We've seen agreements now to capture carbon in Belgium and the Netherlands, to send to projects in Denmark, such as Greensand, and to Norway at Northern Lights. So we're starting to get those regulations in order, and really for the CCUS element, they need working examples to show how a subsidy system would work and how the market's going to work, and to set a floor effectively for the returns that oil companies can get. And part of those learnings are going to be, I guess, brought across into COP28. The other element will be how is ensuring supply to developing markets. So ultimately, developing markets, Africa is trying to increase its production. It needs investment ultimately in terms of fossil fuels, but then the challenge is how to convince banks who are meant to be going towards a green agenda, funding the energy transition. How are they going to maintain investment going into the oil and gas markets to ensure that we don't get a rough transition, as it were, from an oil-based economy to a renewable-based economy. So I think it's probably more going to be about sentiment than anything particularly practical. There'll be a few learnings coming across in terms of maybe CCUS, but they're relatively nascent industries. It's more about the direction of travel and ensuring that the transition is smooth from oil to renewables. Certainly, I think Europe got caught out on that from a geopolitical standpoint in 2022, and I think that.
Well, I mean, it was just. I mean, that was, I suppose, a smooth transition, you would say, but what the Germans had done with their whole overly dependent on Russia was just bad management. I mean, nothing to do with anything other than maybe addiction to cheap gas. I suppose that's not insignificant. Let's go to the survey question and get a thought from the room, and we'll post it on social as well. Just the immediate sense. I mean, Alex is just talking there about more, mid to long-term relevance. But do you expect COP28 outcomes to have any impact on the direction of global oil markets in the first quarter? I mean, like tomorrow, anything coming out of Abu Dhabi? Should oil traders be disrupting their Christmas vacances and celebration of those bumper bonuses to keep an eye on headlines coming out of Dubai, or is it nothing of immediate relevance to them? I mean, where do you think it connects with the oil markets? Yes or no is the thoughts on that. Paul, there is some reporting today that on Bloomberg and others that OPEC may indeed, OPEC Plus, postpone this meeting even once again. What would that tell you? Would the markets care? We just drift along. Your thoughts of the impact of this kicking the can down the road, so to speak, by OPEC Plus?
Well, I think first of all, it shows that actually, yes, you could look at it both ways. You could that they're still far apart on agreement, but also they're committed to getting a deal over the line. So I think if you're shifting it further, it means they're quite close, but it's just not quite there yet. And I think it suggests that there will be an agreement. Whether the market reads it that way, sometimes they like to, depend on where people are positioned in terms of the market, and they sometimes like to kick the market, kick OPEC, and kick the, if it's a bearish mood at the moment, it could go down a peg again, but it's probably going to bounce back up towards the 80 as you start getting the rumors again come out towards likely rumors that you're going to get a deal over the line. So I don't think it's going to affect too much. What I would like to say as well, I just want to pick up, Sean, on the CCUS topic, which is quite interesting, because the IEA and the OPEC have got into a little bit of a spat about CCUS, and
they certainly have.
It's certainly been a political football coming into COP. I think it was interesting because I think the IEA report was slightly misrepresented in the media, in some parts of the media, about being an illusion. I think the IEA are very supportive of CCUS. They talk about it being a credible and critical part of the transition. But I think this is where we're at in terms of COP, in the sense that CCUS is a crucial part of the mix for oil and gas companies to decarbonize. And yet, in previous COPs, it's really been about excluding oil and gas companies from the debate, and about just moving to renewables. So it'll be interesting, the fact it's being held in the UAE, and how important a role decarbonizing of the oil and gas industry is on the agenda and talked about. It clearly is a real important point. I mean, the fact that has come up as an issue when CCUS is a really recognized technology of the transition. So this will be an important point. I just wanted to raise that as well, Sean. Thanks.
Yeah, I wanted to get some thoughts from you also as we go into the question in where we're at in regards to China, Matt, and some of the trade routes and the sort of, obviously the tanker traffic and the container traffic. A lot of that is in terms of the outlook is the Christmas season. Obviously, we're kind of, from a shipping point of view, probably already past that, but we have the China New Year coming. Do we see anything in as I said earlier, that the tea leaves of tanker and container pricing and traffic into the first quarter that would lead us to believe that China can make an improved recovery from this year?
So firstly, looking on the crude and refined product side, the thing with China is, because they have this export and import quota system for crude and refined products, it becomes quite lumpy. So at the moment, we're heading into the end of the year. So people are either trying to use up quotas or trying to drag them out. And on the crude import, crude exports to China have been falling for the last couple of months because they're short on crude import quotas, and they're actually turning more to residue. So they're bringing in a lot more residue for secondary units to sort of make up for that. And then on the products export side, they're very, very short as well. So we've got product exports. Now, this doesn't actually mean that the economy is struggling just based on that. So you don't want to overinterpret what that means. It's just that the government has sort of been short. When we move into the next year, we're going to get it will be the first month will be really interesting to see what the first allocation of those import and export quotas are, because that will be their interpretation on, okay, this is going to be our product export strategy, and this is what we think, these are the refiners we want to support, these are the refiners that we don't want to support. So that will be the first indication of what their interpretation is on that side. I think regarding China's wider economy, I think I mentioned before, I think when you get negative news from China, people tend to over extrapolate it somewhat. Don't get me wrong, they've got some problems, particularly in the property sector, but they're still growing, and we're definitely not anticipating any major collapse or severe contraction. But it's going to be a very, very interesting first 6 months.
Alex, one of the things that we've been following, obviously, as we were talking earlier about the challenges that some of the African countries and others have in expanding or recovering their production capacity, The other big question has been the increase in production capacity outside of OPEC Plus. We saw US upstream and shale in particular doing having a bumper year up above 13 million. We're seeing obviously Guyana and other places. What are your thoughts going into the new year about the extra capacity coming that OPEC needs to keep an eye on, that this sort of non-OPEC group can continue to invest and continue to add production capacity at $80 Brent?
Well, the classical example obviously is Guyana. Guyana is very rapidly building up. It's as a small country with large volumes of oil, it's going to become quite a substantial exporter over the coming decade. Certainly, Chevron basically spent $60 billion to buy Hess on the basis that Guyana is going to deliver these huge export volumes. But in terms of immediate supply, there's a few projects ongoing, but I don't think there's anything.
I mean, we've seen in the shale patch over the last every month, there's an extra ability to add extra barrels. What about in the North Sea? At these price levels, does the North Sea look interesting in terms of new capacity?
So the shale patch has shown some signs of getting a bit softer in terms of rig counts. So there is an element of slowing down there. It is still producing over 13 million, as you said. So there is probably some softness there that maybe it could drop slightly. But in terms of the North Sea, realistically, Norway has very little spare capacity left over, and the moves about a year or two ago now, putting in different windfall taxes on oil and gas producers, chilled some investment activity that was recovering from the oil price crash previously, and the oil price rise. So in terms of the North Sea, there is some limitations. Things like there are a couple of green shoots in terms of Tyra in Denmark is expected to reach first oil in Q1, which should open up gas export capacity from Denmark. There is potentially in an emergency case, if gas drops down, then Groningen could be reopened. But in terms of actual spare capacity, in terms of hydrocarbon production, the North Sea has very limited ability to lift up petroleum production.
It seems so difficult even these days blowing some wind farms. Paul, let's get the survey result and give you last word. I wanted to get your thoughts on one of the things we've seen, and big no in this room regarding relevance of COP to the oil markets, but we've seen in terms of the fund managers and the hedge funds turn away from oil, a big drop in hedge funds and money managers. They seem to be shorting down by half over the last 3 months, from over 600 million, under 300 million. What relevance that is in OPEC's decision making? I know the Saudi energy minister keeps quite a close eye on this particular data point.
Well, ultimately, it's still the physical markets that OPEC can control, the physical markets, and the link between the physical market and the futures and financial markets is still relevant. It amplifies to the upside and it amplifies down to the downside, but they still converge. And the important point to remember is you take enough oil out off the market, it's going to have an impact on supply and demand fundamentals and ultimately the structure of the market. Yes, there is. Certainly gets complicated by hedging and certain positions in the market, but that's ultimately the issue. And I think one other thing it's important to remember that the fact that OPEC has created a nice problem for itself, hasn't it? You just talk about all this non-OPEC supply. It's got what it's achieved. It's achieved when it achieves OPEC at $80 and creates more supply coming on and more investment. What it wants. This is the headache it has. This is the classic market, adage of high oil prices cure for high oil prices. This is going to be the wrestle for OPEC will have going forward if it's successful with $80. That it's going to bring in more supply on and incentivize producers, which is the aim of the game.
As long as it, I suppose, doesn't end up eating their lunch, which is what we saw 10 years ago when shale arrived on the scene in the first place. we'll have to leave it there, but I would take note of this point. It's only a few weeks ago, the Saudi energy minister quite specifically reminded the speculators, as he called them, that they were getting this one wrong. And we do know he has form in making them ouch. So I wouldn't rule that out again with the combined position of hedge funds and money managers now down to just 225 million barrels, having been at close to 600 plus only a few months ago, which is now at the lowest percentile within 20 million barrels of a record low on this net position. So I think something that the Saudi energy minister is probably looking at, whether he's corralling the whole group to a big ouch, I don't know. I'd be cautious shorting this market. We'll have to leave it there and thank our speakers, our guests for their words and insights today. Really great to have their contributions. Matthew Wright at Kepler, Paul Hicken, a petroleum economist, and Alex Hazel at Welligence Energy Analytics. There's analytics and economists and intelligences all over the place, but I appreciate all of their insights. If I don't see you guys again, ho, 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 a happy holiday season to you all, and look forward to catching up in the new year. All the best.
Thanks. Take care. Bye.
Happy holidays all. Cheers.
All the best. Have a good holidays.